Hello, and welcome to today's webinar. We're very glad that you could join us. My name is Billy Carson. I'm with University Conference Services. Before we get started with this afternoon's session, I'd like to give you some general information. First, we have a large audience, so we won't be able to open the phone lines for your questions. Instead, you can type them in the questions pane, which is on the control panel on the right-hand side of your screen. All of your questions are private. No one else can see them, so please feel free to ask whatever you like. Our speaker will answer as many questions as time permits at the end of his presentation. Next, if you are listening to the broadcast over your computer and you're having difficulty hearing, dial into the number listed in the audio pane in your control panel. We'll also send that number out via chat. It should be there now. Finally, we're recording this broadcast and we'll make the link available to you via email. We'll also send out information on HRCI recertification credits. Today's topic, evaluating, selecting, and monitoring target date fund offerings, is something that everyone on your investment committee should be aware of. As you'll hear, while these funds simplify the asset allocation and rebalancing processes for participants, they don't absolve plan sponsors from doing their homework both before and after, including them in the lineup. Fortunately, we have a speaker who's an expert on this subject. Mike Falcone is Director of the Eastern Region and Senior Plan Consultant for 401k Advisors. He is also a frequent speaker at our conferences, I might add. At 401k Advisors, Mike provides consulting services for plan sponsors and their participants and also serves as Project Director for new and current clients. He has more than 25 years of experience in qualified plan design, investment due diligence, funding, and participant communication. Formerly, Mike was a retirement plan consultant with Aon Consulting. He's a graduate of Drexel University, where he earned his BS in mathematics. He holds the Chartered Financial Consultant and Chartered Life Underwriter designations from the American College. He's won industry recognition as one of the top 300 most influential advisors in defined contribution and is among the top 40 advisors in the large plan market. I know personally from the many years that Mike has spoken at our programs that he's very widely respected and appreciated for his expertise and the professionalism that he puts into his presentations. And now I'm going to turn things over to Mike. Mike, you're going to have control here in just a second. Okay, you should be able to advance the slides.
Okay, thank you, Billy. So the first thing I ask is, can you see my screen now?
Yes, I can.
Great. Well, thank you very much. Thank you for that nice introduction, Billy. Your check is in the mail. Hello, everybody. Welcome to the session, Target Date Funds, how to determine the best solution for your plan. And I will share with you that this is a topic that we're talking to with every one of our clients these days. With a lot of the information that's out there, the growth of these funds, the fact that the DOL came out with a tip sheet on it, which I'll talk about in a little bit, and just the fact that a huge amount of money is now pouring into these options. It's a very timely topic for many investment committees to sit down and look at and approach with the same due diligence as you would with your core lineup. So just in terms of agenda, we'll talk a little bit about target date funds, give you the basic definition, share some statistics with you, talk about some of the key terms and concepts that you need to be aware of. Talk about the process. You know, how should you as a plan sponsor go about the process of evaluating, selecting, and monitoring target date structure for your plan. And then I'll share with you a case study where we bring it all together. So target date funds defined. In general, it's a series of funds that gradually grow more conservative over time. The year in the fund name is typically the date that a participant is expected to retire, and that's usually linked to age 65. And there are glide paths that the fund follows, and the fund becomes a little more conservative as the fund approaches its target date with respect to exposure to equities. There are a lot of fund series out there, and this is just an example of two. Right now in the marketplace, there are at least probably 50 offerings in this space, and they vary. Every single fund varies by its structure, its glide path, its purpose, its philosophy. There are no two that are alike. Just to give you share a little example, the two that we're sharing here and a common term you're going to hear throughout this presentation are the concept of to retirement and through retirement. A to retirement fund series is a series that has an equity exposure that winds down to the age 65 target date and then remains level from that point forward. So in that regard, look at the green line on the screen, and you can see that this series starts with an equity exposure of 85% that runs out to age 40, roughly 25 years prior to the target date, and then it starts to become more conservative, hitting a point at age 65, the target date, where there's a 33% exposure to equity, and it remains that way throughout retirement. So that's known as a to strategy. A through strategy, on the other hand, will continue a glide path beyond the target date. So that's the blue line in this example. 90% exposure to equity up until the point in time that's 25 years prior to the target date. Then it will begin a wind down, but the wind down doesn't stop at age 65 or the target date. It continues all the way to the point in time where the individual would reach age 95 or be 30 years beyond the target date. So again, there are no two fund series that are the same. The big question mark that you would have as a plan committee is how do you choose which one or which series is right for you? When you look at the conundrum out there, they're becoming the most widely used investment option in defined contribution plans. They're currently offered in over 70% of DC plans. The assets are projected to represent roughly 70% of all DC assets by 2020 and grow to $1.5 trillion in assets over the next 10 years. Now, I've gotten an updated number on that. It's closer to $2.5 to $3 trillion. On the flip side, they're also the most misunderstood investment option. The target date fund name doesn't reflect the risk of the fund itself. There are no two 2020 funds that are alike. If you use the Vanguard 2020 fund, it's different than Fidelity's, it's different than T. Rowe Price's, JP Morgan's, BlackRock's. Everybody has a different way they're going to manage that 2020 fund. So no two are alike. And one of the biggest things we saw and why there's so much focus on this is that in 2008 and 9, when the market took a big dip, those funds that had 2010 after their name experienced losses ranging from 3% to 41%. All the more reason why you can see that no two are alike. It's also a fiduciary time bomb. When you think of the amount of money that's going into these funds, the fact that they are the qualified default investment alternative designated by the vast, vast majority of plans, there is a fiduciary process, and it's important that plan fiduciaries understand, know how these funds work, communicate them appropriately to the plan participants, and have a process in place to monitor them periodically. As I mentioned earlier, there's heightened security both from the SEC and the DOL after the 2008 downfall because of the variation in returns. And I would tell you probably the biggest thing was that we had a lot of reaction from plan participants who really didn't understand how these funds worked. A lot of participants that might have been in the 2005 or the income fund or the Today fund of their provider. A lot of those participants expected that they could not see their account go down in value, that it operated more like a money market or a stable value fund. But the reality is even the most conservative funds in the universe have at least a 20% exposure to equity at the target date. So it really pointed out the need for further due diligence on the plan sponsor side and a significantly enhanced communication on the plan participant side. Mentioned earlier, all the 20, 20, 30, 40 funds are not the same in terms of risk and expected return. So Morningstar does their evaluation of target date funds. It's very good, but they do look at the fund name, the fund number, and throw all the 2020 funds in the same bucket. The problem is that if I've got an aggressive 2020 fund and I've got 60% exposure to equity, and I'm comparing that to a 2020 fund that's got 20% equity exposure, the 60% exposure is going to have great returns in an up market. And vice versa, the 20% equity exposure fund will have great returns or better returns in a down market. So you can see it's really not appropriate just to look at funds by the name or the number after their name. Plan sponsors also have a fiduciary need to do the ongoing due diligence the same way you monitor your core lineup. Yet what we've seen is nearly 40% of the plans that have both target date funds and a formal investment policy statement don't address how the target date funds are going to be evaluated. So a couple key things you need to be aware of and questions you need to be able to answer as a plan sponsor and understand. What's the glide path of your target date series? At what point does a static allocation begin? In other words, when does that glide path level out? What asset classes are represented in the portfolio? What assumptions does that provider, that investment manager, make about longevity, income replacement, and market risk? How are they addressing inflation? What's your process internally for evaluating fund performance? What about fees and how they compare to alternatives? And what do you know about the organization managing the TDF, the target date fund, the people, the process, their philosophy? So it's really important that these are questions that are going to come up. You should be able to answer them, or at least have somebody help you find the answers to them. A couple key concepts and terms. We talked a little bit earlier about this equity glide path. So that's the beginning exposure. What does a fund look like at its highest percentage exposure to equity and its lowest? And how does it get from one point to the other? That's considered the glide path. The roll down strategy is at what age does the glide path begin and when does it end? Equity exposure at age 65 at the target date is really significant. And as we talked about earlier, when we looked at the 25 and the 2010 funds, the range of equity exposure is anywhere from 20 to 60%. So that's going to come into play when you try to figure out what's the best solution for your participant group. What about the investment philosophy? Is the fund actively managed or passively managed or a combination of both? The investment type is a fund made up of proprietary funds, outside funds, and or individual securities. One of the things that the DOL mentioned in their tip sheet was that committees should consider at least looking at custom target date fund solutions. And we'll talk about that a little bit more as we get into the case study. And then asset classes. What does a fund invest in beyond the core asset classes? So do they have any exposure to TIPS, REITs, emerging markets equity, high yield, emerging markets debt, etc.? So we believe, the process of going about and identifying the best solution is really looking at a three-step process. Excuse me. First is identifying the best target date fund strategy, the fit. So you want to look at the plan, goal, and design analysis. What does your design support? What does your overall program deliver? And where does the target date solution fit in? Then you want to look at the funds and see how they perform. Have some process, whether it's a scoring analysis that we use or an evaluation process that another advisor might offer, or looking at Morningstar, but looking at how the fund series does and look at it as a group. You can't look at them in isolation because some funds within the series might underperform their benchmarks, but you can't necessarily take that single fund out and replace it with another fund. So for instance, if you have the Fidelity Freedom Fund series and you realize the 2020 fund is underperforming and has done so for an extended period of time, normally as a standalone fund you'd be thinking about finding a replacement for that. You can't just go to the market and take Vanguard's 2020 fund or T. Rowe's 2020 fund because they manage those funds differently. So you really need to look at how does the entire series score, and does the entire series still merit its place on the investment platform. And then you want to look more qualitatively. The philosophy of the organization, do they take an approach that's actively managed, passively managed, a combination? What types of investments do they use, and what kind of coverage do they have? So looking at glide paths, the way we qualify these solutions, we break them into three buckets typically: conservative, moderate, and aggressive. And we'll consider a fund, the target date series, one that has a low equity exposure at age 65, that being less than 30% exposure to equities. We'll consider a moderate solution somewhere in between 30 and 40%, and then an aggressive will be somewhere above 40% at age 65. So identifying the strategy fit. So there are a couple things you'll look at. One is plan objectives, plan demographics, and participant behavior. And the combination of those three should lead you to a target date fund plan goal. So what we've done is we put together a decision tree, and this isn't to say this is the absolute, but it's a process. And the DOL is very much about process. How did you go about looking at evaluating, selecting, and monitoring funds on an ongoing basis? So a couple things you'll look at here. First is plan objectives. Look at the overall totality of the retirement program that you offer. Is the 401k plan, the 403b plan, the sole source of retirement income that your participants are going to have from your organization? Or is it a supplement to a defined benefit plan, perhaps? So if you had a DB plan, you might be going down the right-hand path. If all you have is a defined contribution plan, you might be looking at the sole source, and it take you down the path. So let's just take this a little bit. Plan objectives, the 401k plan, the 403b plan on the right-hand side is the retirement plan of the organization. Looking at it from design perspective, you've got auto-enroll, auto-escalate features. Then you look at the participants stay in the plan throughout retirement. If so, it might lead you to a moderate target date fund design. If they take their money after they leave the plan in retirement, it might be more conservative. So a couple things you would look at, and just one of the trees that you look at as you're trying to come up with the right solution. Next, you want to look at your plan demographics. So look at the behavior of participants. Are they below average investment knowledge, above average investment knowledge? Do they contribute a lot, contribute a little? Do they have low account balances near retirement or high balances near retirement? So you can see that a plan that has above average participants, high contribution rates, might take a conservative approach. They're going to get there, so maybe you don't want to take as much risk with that bucket of money. If people aren't contributing enough, you would probably need to take on a little bit more risk within that target date fund solution. Then you also want to look at participant behavior. Are participants involved or not? And I would tell you, for the most part, what we see in the marketplace, 70% of participants really don't want anything to do with the investment decision. So a target date solution is probably the best solution for them because it gets them in the right bucket with the right MISC. It does the auto rebalance. It does the automatic wind down for them. So it's a good solution for a vast majority of the people in your plan. But then you want to look at, what do people do? Do the people stay in the plan once they leave your company, leave your organization, whether it's just through termination or through retirement? Do they tend to be risk averse, risk neutral? Are they risk acceptant? So a whole bunch of different things that as you're sitting down and going through this process, again, you're going to look at plan objectives, plan behavior, and then participant behavior. And it should lead you down a path to what might be the best fit for your organization. So the first step is really trying to figure out, do we go with a moderate, through solution, aggressive, conservative? The next thing we want to do is have a process to look at the funds themselves and which managers are doing the best job in adding return to participants. So the first step is, identify a target date fund that matches the plan's best fit risk profile. Create custom peer groups. We think the best way to evaluate these managers, and it differs very much from a Morningstar approach, we think the key determinant of where a manager belongs is how he's allocating his assets between U.S. equities, international equities, core fixed income, and cash. So that will dictate whether that fund profile from a risk perspective is conservative, moderate, or aggressive. And then what we do to find out how well the manager is doing is create custom benchmarks based on those allocations. Because that will help us identify in each of the individual segments, are the managers combined in that particular mandate outperforming the benchmark? Are they adding value above and beyond what average would be had you chosen to go with a pure index solution? And then you look at and identify how the manager's done from that peer group. So we think a more detailed process is one that really helps identify how good a job the managers in a particular shop are doing in adding value to the people that invest in those funds. And remember, the bottom line is we want to look at the fund scores as a plan, as the group in total, and what the average score is, not just the individual solutions. So here's an example of some of the things that might come into play. So a conservative glide path solution would have a starting equity exposure of 81%, stopping at 18%. It would go 81% out to the point in time the individual is age 35. It would drop down and end at 18% at age 65. Would be active funds, proprietary funds of the provider, have a fair amount of core coverage. Whereas when you look at an aggressive approach, it's going to have a little higher equity exposure. It's going to extend that glide path. It's not going to start its wind down until it reaches age 40. And it's actually going to go beyond retirement, where it will end at 40% at age 80, but that means it's got a much higher equity exposure at age 65, 60%. So again, 3 different offerings, 3 different types: conservative, very, very conservative at age 65, stopping there; moderate, same thing; somewhat middle of the road, stopping there; aggressive, fairly high equity exposure at 65 and continuing to wind down beyond that. The other thing we talked about is making sure that the managers are measured against an appropriate peer group. So that would be, again, looking at how the manager allocates his money among those asset classes, put them in a risk bucket, and then everybody that invests in a similar style would be part of that risk bucket or that peer group. Here's an example of how we divvy up the groups. Conservative managers typically will have 5 to 20% U.S. equity, 0 to 15 international, 50 to 90% fixed income, and up to 30% cash. So what we try to do is we look at the way a fund is actually diversified among those classes, and we identify a best fit. It's not going to be exact, but we identify a best fit. And that's the risk bucket that this individual manager would be in for this particular fund. And then have a process, whether it's a process that we use or another advisor uses, have a process that helps you figure out who's doing well and who's not. Our particular process, it's a 10-point system. We look for scores of 7 or better. If it's below 7, then we look for opportunities to change the funds out. Focus on the average score for the series. So this particular series is averaging a 6. That's not a good score in our system, and it's been fairly consistent. So I would tell you that for this particular series, we're probably talking to this individual client about finding a replacement series. Step 3 is the qualitative review. So that goes more to the right-hand side, looking at the makeup of the fund. Is it an actively managed or passively managed solution? The investment types, is it proprietary, or are there outside funds? Is it custom fund lineup? And what about the asset class? What do they include? Core plus tips, emerging markets, etc. What kind of coverage do they have across the different asset classes? So with that, I want to flip over and take you through a case study and how we evaluated and looked at the existing funds for a particular client and the process we went through to determine whether or not those funds stayed or whether we found a replacement series. So the client in this particular situation was a large provider of communication, engineering, integration solutions to defense, commercial, and government industries. They had a combination of plans. They had a cash balance pension plan along with a tax-deferred savings plan. And the goals of this particular exercise were first and foremost to satisfy due diligence. They were concerned that they hadn't done anything to do more of a deep dive and evaluation of their target date fund solution. So they wanted to have the process in place to do that, and ultimately determine whether or not the target date fund series they had in place was still the best fit, or if there was a better solution out there, and then have a process for doing the ongoing monitoring of the new funds if they did choose to switch. So a couple things. We talked about looking at the plan, the overall plan. So the cash balance plan, average balance of $80,000 for all participants. For the individuals that were 50 and over, those within the last 15 years of the glide path or dates leading up to retirement, the average balance was $125,000. And what we saw for the most part, the behavior in this plan was that when participants hit the target date or hit age 65, retired, the plan allowed for them to take up to half of their account balance as a lump sum and the other half as an annuity, and that's exactly what most of the people did. Now within the savings plan, the plan itself had total assets of about $375 million. Over a third of the money was already in the target date funds. And the target date fund solution for this particular client was the proprietary offering of the plan record keeper and administrator. Another 15% of the money was in the stable value fund. So half of the money was either in what used to be the QDIA or it was now the QDIA. The average balance in the savings plan was $90,000 for everybody. So when we looked at the demographics and where the money was spread, highlighted, you can see that 36% of the assets were in the target date solution. Another 15% were in stable value. And then another 38% were in the active equity solutions throughout the plan. So pretty widespread. On surface, what we'd look at and say that is somewhat normal behavior that we're seeing in plans nowadays. Anywhere between 30 and 50% of the money is in target date, 10 to 20% in stable value, and the rest mixed among the other asset classes. One of the things we wanted to focus on for this particular plan was take a look at the behavior just within the current target date solution and focus on those people within 15 years of retirement. So what we did, we went to the provider and said, could you break this down for us by active employees, those still working for the organization, and those who have terminated and left the organization but left their money in the plan, and break it down by age cohort, age bracket, and then by fund. So what you can see is down this column, those that were 50 to 54, 372 in total active, 204 non-actives. Now, the one thing you need to understand is these are accounts. These aren't participants necessarily. There may be some participants that split their money among one or more funds in the target date solution. And it's one thing that we urge a lot of clients to look at periodically is go back and look at investment behavior within your plan. For the most part, the yellow highlighted areas would indicate what would be the most appropriate target date solution for somebody in this age bracket. So you can see there are a lot of outliers. And as you get further out, the one that's probably jumps out the most is in the 65 and over category, there's one individual that's got their money in the 2030 fund. So that's something you'd probably look at, that's 25, now that's, I'm sorry, do the math, that's about 15 years from now, probably a little bit more aggressive than you would think that individual should be invested. So a couple things that we gleaned from this. There were a lot of people that left the company and continued to leave their money in the plan, 503 accounts in total. Of the active participants, and there were 3,000 participants in total. Now there are 4,000 participants in total. Almost 25% were in target date fund solutions. So you can see this is very prevalent. People kept their money in the plan, and sort of, especially the terminated and especially the over 65, seeing the numbers that we did, wasn't really that surprising because of the existence of the cash balance plan. Another thing that comes into play is how the plan is affected economically by changes to the investment lineup. So for this particular plan, you can see how the money was divided up among the different asset classes, what kind of revenue sharing that generated to offset record keeping and administration, and what that meant in dollars. Now, with this particular client, prior to doing the target date fund evaluation, we had already gone through a benchmarking exercise and had their provider reprice the plan and they did so in a manner that said, we need 11 basis points to manage this solution. So based on this lineup, we're getting 17. That's generating 6 basis points of excess, or $227,000 based on the current fund lineup. Now, there are a fair amount of expenses they were paying outside the plan that they could now use some of this excess to pay for. But it also provided us a little bit of a cushion if we're going to make a change to the target date fund, and this number, the revenue sharing number, was impacted by that. So it gave us some leeway and leverage in the market. So a couple things out of the gate. One was, with the existence of the cash balance plan, many of the participants were looking at the savings plan as more of a supplemental rather than the major source of retirement income. The behavior we saw in the plan seemed to indicate that they had a greater willingness to tolerate a little bit more volatility. So that sort of led us to believe that maybe a more aggressive strategy in a target date solution would work. Many former employees, including those at or beyond retirement, continue to invest in the plan and in the target date funds, which also led us down the path to a through strategy. And the plan economics that we talked about earlier provided us a lot of flexibility to look at various solutions: retail versus institutional, mutual funds versus separate account, etc. So the process we went through was very formal for this. We looked at it and said, we've got a lot of money in play, so we'd like to have a really good feel for the people that we might entrust this money to. So we identified a short list of providers to include in the evaluation. We did want to look at 1-2 retirement solution and 3 through retirement solutions. And I will tell you, the incumbent provider was a through solution. We distributed an RFI. We did a preliminary analysis. And under that, we looked at the fund performance by fund series, by target date, and by risk category. And from that, we cut the list down to a smaller group, invited them in for presentations, did follow-up, and then we made a recommendation. So the first thing we did, just looking at things performance-wise, was look at how the funds performed by the series itself. So ABC was the incumbent. When we looked at the strategy based on the allocation, they plopped into different buckets as follows. The income fund was conservative, etc. We looked at the 5-year returns. We looked at the scores. 5-year returns were just that. The scores represent much more than just the returns. They represent how the fund does relative to the risk profile, up-down capture, takes into account risk as well. So the incumbent fund series in this particular sample was averaging just about a 7. XYZ is one we looked at, a little bit more aggressive, by fund. Returns were a little better, but the scores, again, were much higher. Then we took the Morningstar approach, and we looked at it by the fund number. And the first thing that jumps out of the gate is just by fund number, you can see that the strategies differ. 3 of the funds are moderate aggressive, 1 is moderate. So is it really fair to compare the GHI 2020 against the other 2 fund families in up markets or down markets? Up markets, they're not going to do as well as the moderate aggressives. Down markets, they'll do better. And this particular example took into account the period of time when we went through that market downturn. So you can see the 2020 fund, it was a little bit less aggressive, had better returns, 5-year returns, than the other 3 funds. So another reason why not to just focus on the fund number. Then we looked at it by risk profile. We said, forget about the name. Let's just put everybody that's in the moderate bucket together and see how they compare. So we felt this is a better approach on how we compare the managers in each bucket, and a better opportunity for us to identify who really, from a management perspective, is adding more value and providing excess return to their investors. So a couple of things we walked away with through this evaluation. The most appropriate glide path match was through retirement. And again, we looked at the plan demographics and behavior. From a mapping standpoint, it aligned pretty well with the incumbent fund family. And I would tell you that's one of the key things you need to take into consideration if you end up making a change from one provider to the next. That fund mapping is going to be very significant More often than not, you're going to map by fund number, but it's going to require significant communication on your part to make sure participants understand that, hey, we're taking you from the XYZ fund series. All the money you have in the 2010 fund is going over to the ABC company 2010 fund. By the way, that might be a little bit more aggressive than you like. We're changing the allocation by making that strategy change. So it's really important to look at matching the funds up by number, how participants are impacted in terms of their allocation for that particular fund. We also looked at and said XYZ had the most consistent risk-adjusted performance. The team been in place since the funds were founded 12 years ago. From a record-keeping standpoint, there are also a significant number of ABC's clients. ABC was the record keeper and the incumbent fund manager. Significant number of their clients already using XYZ target date funds. So they've worked together in, implementing, communicating, and carrying out the change. And then from a pricing perspective, what we looked at was it became revenue neutral when we compared it to moving to a less expensive share class of the incumbent providers' funds. But it also created an opportunity for us to move to a trust version of the new providers fund in the future. That flexibility that as the plan grows, as we have an opportunity to continue to look for ways to lower expense to participants, we had that in front of us. So from a process standpoint, we finalized the fund changes early to mid-July. We notified ABC the changes late July. We worked with both the incumbent and the new provider to put together a strategy for the target date fund switch, did that in early August, started to roll that out in mid-August, and the goal was to have the fund lineup in place by October 1st. Now, I would tell you that for the most part, fund changes, just single fund changes with a provider, you're typically looking at a 45 to 60-day period. When you're talking about switching out an entire fund series, like a target date solution, you might want to extend that a little bit, maybe go to 90 days, just because it's probably the most significant change you're going to make. It requires a tremendous amount of communication and education to your participants so they understand what's going on. And from a fiduciary perspective, it's just making sure you dot all the I's, cross all the T's, and get it done right, and don't leave any questions unanswered. So a couple things to consider. We talked about it earlier. Target dates are going to continue to gather more assets and grow in importance. Again, the latest numbers I saw on a presentation from one of the providers this morning was that they are estimating that target date solutions will grow to $3.7 trillion by the year 2020 and represent 48% of the entire defined contribution marketplace. That's everything that's considered in a savings plan. So they're going to continue to grow and take on super significance as time goes on. It's really important that you have a process to understand, evaluate, select, and monitor performance of your target date funds, just as you would for every other fund in your lineup. Don't settle for the house brand. There are all alternatives. So one thing you could look for is, do you have an opportunity with the incumbent, assuming they're performing well, to get a less expensive share class of those funds? Are there target date fund solutions managed by someone other than your provider? And I would tell you that providers are becoming more flexible and more open in allowing their clients to move from their funds to that of another provider. And would you consider custom solutions? So this is one thing that I'd mentioned earlier, that the DOL came out with a tip sheet in the early spring, and I will, if you want to email me, I can email you the link back to that tip sheet, or even just send you a copy. But part of what they said, and I'll go down bullet point, were things to remember when choosing target date funds. Establish a process for comparing and selecting target date funds. Establish a process for the periodic review of selected target date funds. Understand the fund's investments. Review the fund's fees and investment expenses. Inquire about whether a custom or non-proprietary target date fund would be a better fit for your plan. Develop effective employee communications. Take advantage of available sources of information to evaluate the target date fund and recommendations you received regarding the target date fund selection, and document your process. I would tell you the thing that jumped out the most to both advisor world and the provider world is the bullet point about asking about custom fund solutions. It can be fairly a significant endeavor to go to a custom solution. There are challenges with respect to who's going to control and set the target date, who's going to control and set the glide path and do the rebalancing. How do you select the funds in the custom solution? Are the same funds that are offered in the custom solution available on a standalone basis in your plan? So there are a lot of questions, and I would tell you more often than not, this is something that starts at the large plan level. So there are a lot of large plans that are looking into this because they can do it economically and by volume. Typically, we're seeing it maybe a solution in a $250 million plan and above. So that will continue to trickle downstream as providers can accommodate those solutions. But there are a lot more things that you have to take on as a plan fiduciary, as a committee, or your advisor needs to take on that are handled by an outside provider that has a premixed solution. So you want to evaluate, does it make sense to go the custom route? Does it make sense to go proprietary, incumbent, other provider? There are choices out there, and don't feel that you're stuck. And one other thing to take into consideration, that if you're with a provider, if you're with a record keeper administrator where you don't have choices and that target date solution is not performing well and you would otherwise consider removing them from your plan, you really need to think about moving to an alternative provider. It's a very significant decision, and you can't just stay with a provider because that's the only solution they have. Last and most importantly, document the process. The DOL all is about process and documentation. They just want to see that you put some thought into whatever you're doing, that you went through a process, that you were prudent about it, that you documented what you did, and you felt good about the decision that you made. So if anybody ever came up to you and say, well, why do we select these funds or this fund series, you've got a well-documented process to support that decision. So just a quick recap. Most widely used, remember, we're considering it's going to be upwards of 70% of assets by 2020. They're still misunderstood. The names don't reflect the risk postures. Remember that there's certain 2010 funds that have 20% equity and some that have 50% equity. And strategy, avoiding a time bomb. It's all about process. This is going to be a major area of focus over the next several years. Important to have a good process in place so if you're ever challenged, you have something to support it and document it. So I'm not going to spend too much time reading through the disclosures here. But okay. I will tell you that if you'd like a copy of the presentation, be happy to email me. I will send it to you along with the DOL tip sheet. And if we have time for questions, I'll take them now.
We do have a few questions, and several of the questions had to do with how to contact you to get information, especially on that DOL tip sheet. And you see it there before you, Mike F. at 401kadvisors.com. We do have a couple of specific questions here. How common is it to have a set of customized target date funds? Is there an asset size when this approach is feasible?
We talked about that a little bit. You're seeing it mostly now discussed in the large plan market. So there are a lot of things that go into it. Who's going to determine the glide path, the roll down strategy, effectuate the roll down strategy, manage the entire process. If you're doing a fund of funds of the core funds in your lineup, you need somebody that's going to act as custodian and create a strike price. So right now, the custom funds made out of the core lineup are typically at the large plan end, and by that I mean typically $250 million and above before you have those conversations.
Okay. We've got another one here. If my goal as a fiduciary is to mitigate risk, why wouldn't I just go with passive?
Very good question. Very good question. We get that a lot of the time. One reason I'd say is you can't effectively index the entire market. There are certain sectors of the market that are not efficient, and you can add value by having more of an actively managed solution. That's not to say that an index solution is bad. The flip side is there are good managers out there, there are good target date fund managers out there that have managed to do well and outperform the index. So it's that ages-old discussion that if I'm Jack Bogle here, I'm telling you should always index, but if I work for Fidelity or T. Rowe, I'm telling you should buy active management. There's no definitive answer one way or the other. It's all part of the evaluation process. I would tell you that most of the key funds have at least some bit of an indexing where it makes sense, but for the most part, they're looking at active solutions.
Okay. You discussed the need for custom peer groups and custom benchmarks. Is it possible to do an effective performance review of TDFs without the help of an expert? I'm thinking specifically about mid-sized sponsors.
DOL is all about prudence and process, and if you follow the prudent expert rule, it really would say if you don't have the expertise in-house to do it, look to somebody on the outside. Normally, if this were a core lineup, you might just be able to rely on something like a Morningstar, but we don't believe a canned solution that's more geared towards a retail world is the best solution for institutional retirement plans. And as we mentioned earlier, even though Morningstar does their evaluation of the target date fund solutions, they're doing it by just lumping all the funds with the same number together. And we've seen, based on risk profiles, that that's really not an appropriate way, and it doesn't lead you to be able to identify which managers are really doing a good job of outperforming their peers.
Okay. We've got a real specific question here, and I don't know whether you'd be in a position to answer this, but I'll throw it out there anyhow. How does, for example, Prudential's Goalmaker program differ from target date funds? I think there's some confusion in the marketplace because not everyone calls their funds target date funds, and I'm not familiar with this, and maybe you can shed some light on this.
Well, the target date fund is set. So if I'm investing in the Fidelity Freedom Funds, for instance, and I anticipate that I'm going to retire in the year 2025, I'm in that fund just like everybody else that's in that fund. There's no discretion. I get what the mix is. And Goalmaker, they go a little bit further beyond and do some investigating, ask some questions of you to understand risk profile, where there might be other resources, what kind of tolerance you have for ups and downs, and come back with more of a custom solution that's built around you based on the funds in your lineup.
Okay, very good. Thanks for that. One other one, this is in a little different tenor, and you touched on it briefly before about how participants are using target date funds. Are they generally sticking to one fund, or are they investing in several?
It's not uncommon to see participants invest in two funds. And let's say, and that was more common when the fund families only offered these in the 10s. So you had the 2000, the 2010, the 2020, 2030, et cetera. So if, go back to my example. If I was anticipating retiring in 2025, they didn't have a fund that fit for me. I might put half of my money in the 2020 and half of my money in the 2030 and think that it would get me to on average that was a 2025 fund. Well, now everybody has the 5 series, so that is sort of fit. But what if I'm 2023? Again, somebody might try to balance the two. You can make an argument that maybe it makes sense to split 2, but once you go beyond 2, there's really no reason for somebody to have their money split among 3 target date funds or 4 or 5. The other thing we see is target date funds really should be an all or nothing proposition. So if you're going to invest in a target date fund, all your money should be there. You shouldn't put half your money there and then spread your money elsewhere among the core funds. You're defeating the purpose of the target date fund. Although I can tell you, I have some people that do that just to test how well they do compared to the target date fund manager. But for the most part, target date solution should be an all-in. It shouldn't be any more than 2. More often, it should just be the 1, and it should be the one that's most closely aligned with your age 65 birthday.
Okay. Well, thank you for that. And that finishes up the questions that we had. I'm sure people will have others and will be interested in contacting you, Mike, about getting a copy of the presentation and also the information from the DOL. And again, that email address is mikef@401kadvisors.com, and that is you'll see that on the recording. We're going to send a recording link out tomorrow, and that'll be there. So. I want to thank you, Mike, and thank you, audience, for logging on to today's webinar. We hope you'll join us for other webinars and at one of our 2014 Mid-Sized Retirement and Healthcare Plan Management Conferences. Mike and his colleagues at 401k Advisors will be doing workshops for us, including a day-long fiduciary tutorial that Mike always does, and it gets rave reviews, so I'll put a plug in for that. As a reminder, you'll receive a copy of today's presentation via email, a link to the presentation, I should say. And we're also going to send you information on how to get your HRCI credits. Again, thanks very much for joining us, and have a great day. Bye-bye.
Thanks, everybody.